So anyway, so thank you so much everyone for joining. So Ankit and myself are your hosts today, and the topic of the day is really one of the simplest topics that most people in overall financial markets don't really think about. What is a true price of an asset? And we today want to specifically focus on blockchain and in particular KASPA and Bitcoin. But even though Ankit is saying that we might actually touch on some traditional markets as well, which will be very interesting, to compare. I don't know if we're going to go down there, but for me personally, it would be actually interesting to compare how does the traditional market and obviously blockchain, how do they differ? And yes, we have an amazing list of guests today, guest speakers. So we obviously have Eliott, who is working on Oracle solutions with Jonathan. We have Dmitry, CEO of Quex Oracles, who is a core dev, used to be core dev of Cardano in the past. We also have Seb, who writes educational content on money and has a very keen interest in oracles. Yes, so please say hello to our amazing guests. Thank you. Thank you, Angel. And yes, just a little bit of ground rules. So as I mentioned, please do retweet. And the space is open. So if you have any questions, you want to jump in to contribute, please do raise your hand. I will add. I see some of the people already asked me to add them as a speaker. Or if you are too shy, please do write a comment or question underneath, and I'll make sure to read it so that our speakers can answer. But yeah, without further ado, please.
Cool.
Yep.
Thank you, Christina. I think you forgot to welcome Jack from
Oh my God,
Cascade.
Jack, I'm so sorry. Jack, I'm so
Jack.
sorry.
No, no worries, no worries. I'm just lurking, you know.
No. You are very important here as well. So please welcome Jack as well from Cascade.
Yeah,
Thank
no.
you, thank you. Happy to be here.
It's definitely important to get everyone recognized. But guys, thank you again. As I said before, I think Dmitry, you joined us. We just jumped in right away before even introducing everyone. But yeah, we just I guess just to add a little bit more context here, right? I've done two actually podcasts. One with Eliott and Dmitry. We did recently with you, the last episode with yourself, really highlighting the challenges. And one of the interesting things that really stood out to me was, somehow we started talking about the Quex and the partnerships you have done with likes of Igra and Kaspacoin, and then we obviously pivoted more towards the price, like what is the true price, and I think that is the question. Perhaps we dabble a little bit in the on the podcast, and podcast is more of a confined space because you have limited time. We're trying to rush through a lot of topics, especially when you have the guests for the first time. But spaces are more, I think, friendly and it's open, and you can have a little bit more back and forth on topics rather than having more organized spaces as podcasts. So I thought, and then I think what happened, Eliott and Seb had a very very good engaging discussion on the post we did on actually X around the price around the price of an asset. So I thought it'd be great to have this space to get you all here, and let's just have we're not trying to answer anything here. I think I just wanted to spend time focusing on the question itself. What is, and it's going to go in different direction because I think I've spent a lot of time on traditional markets, really the plumbing of traditional markets, which I don't really tend to spend time in discussing. So I do want to bring that up in this discussion because the same principles that we're going to discuss today do apply to traditional markets. In fact, we can learn a lot from traditional markets. So, so that's just my monologue first. So, why don't we actually start with Eliott, yourself, or Dmitry, guys? Like, you both are probably the closest to this thing, right? You both spend time on this topic of price of an asset. Perhaps Dmitry yourself, we touched upon that on the podcast, but why don't you define what is the challenge today with finding the price of an asset?
Yeah, let me try to recap maybe a little bit what we discussed during the podcast with you. So actually, usually the simplest request we get is like, we need a Bitcoin price, or other cryptocurrency. Likely it's, if you're going to any chain, you need the price on native cryptocurrency. Discussing KASPA, it's Kas. Yeah, for other chains it might be different. But when you go more precisely in what is under the hood of this question, like you need a Bitcoin price, you realize that people are asking this price very precisely, with very low deviation from the price, and very fast. And the problem is that it's not that easy to do both of them. If you'll take a look to like CoinMarketCap right now, you'll see some kind of Bitcoin price. I see right now that Bitcoin price is 108,380. But if you go to markets, you see that on different exchanges, it varies slightly. On different paces, varies slightly. Right now, again, from 108K to 115K, actually, on Upbeat. It's usual, Kimshare premium. Likely now, it.
Yeah.
If you wish to get it fast, you can't wait too long to make aggregate price from all the exchanges. Remove spikes, remove short price movements. But if you want it to be very precise, you have to do it. So sorry, I was muted somehow, but yeah. So
I think Christina, you muted everyone. I think for a second.
Yes, so sorry. I think I pressed the wrong button.
Sorry, yeah.
It was not intentional, Dmitry. Sorry.
Okay, I'm shut down. So that was the recap what we discussed. So
right. Yes. Yeah.
Different purposes. It's not that easy. So let's go here. So we have Bitcoin price, and it's a liquid asset. It might looks easy, but it's not that easy, in my opinion. So let's go.
Yeah. So Dmitry, just on that bit, right? Like as you're saying, if you go to CoinMarketCap, hey Gaza, sorry, Ghazi, sorry if I'm pronouncing your name wrong. Please hold tight. We'll get you up there in a second. But yeah, so Dmitry, I think as you're defining the problem, right, or perhaps you're saying, go to CoinMarketCap, look at the price of Bitcoin, you'll see average. But within, if you go to the exchange tab, you can see the price difference within. I'm looking at it right now. It's 108,695 is the Binance price, which is the USDT pair, and then you have $100 difference with FDUSD, and all the way I think OKX you have even further difference. I think it's a few $100s. Oh boy! And then there is an Upbit. Actually, this is a good one. Upbit. It's showing 114,000. I don't know how that's possible, but it's showing 114,000. This is BTC to KRW. I don't know what the pair is. KRW is not USDT, so maybe that's why. So I guess that's the challenge that and these are all exchanges, centralized exchanges. We're not even looking at decentralized exchanges. The price is already different, and these are the top ones. So that's I guess why we are here to discuss this, right? Why price is different, and even this price is it the price that we can consider price, right? So I think perhaps Eliott, you can jump in here. If what's your sort of take on this challenge?
So I think firstly, the reason we can see so big price differences between exchanges is partly because crypto is still blooming. It's inefficient. If you compare it to traditional finance, normally there's no huge arbitrage opportunity. I mean, there are quite a bit, but
Yes.
it's saturated because you have like hedge funds turning high frequency trading algorithms
Yeah.
all day. So
Yeah.
as soon as there's money to make, they make it, right? And in crypto, I think that, for example, one of the reasons I can think of why there are these differences is because exchange is less regulated. You can block trading. You can slow down orders. You can,
You mean the
like, there's a lot.
crypto exchanges, right?
Yeah,
know,
crypto exchanges,
yeah.
which will result in different prices because you have way more control than you like. Funnily enough, you have more control, I think, than in traditional finance because you're less regulated. So
Yes, that's so true.
Like on the 10th, I know of a friend who did manually arbitrages of like 20%, selling on one exchange and buying on the other. 20% is ridiculous that a bot or a trading bot didn't front run him on that arbitrage and close it fast enough. Like, these arbitrages shouldn't exist. Not at human speed level reaction time, you know?
Yeah, for sure. So Dmitry, please jump in. Yeah.
Yeah, so let me try to add a little bit here. So when we discuss updates, it's Korea one, it's fiat currency, so it's not crypto. And the problem is here is that arbitrage is not that easy because
I see. That's a good one. Yeah, thank you.
So the problem here is not because of like it's different currency. It's a fiat currency. It's a problem to exchange crypto to fiat and back. And in Korea, it's highly regulated. It's not that easy to do it. That's why you cannot arbitrage it. I've done some kind of arbitrage training in the past, actually, by myself also. So in most cases, it's very efficient stuff. The difference here, in my opinion, the difference between like crypto and traditional markets is a different market structure right now. And if we're talking about stocks, in most cases, you have only single exchange where the stock is listed. Yeah, so if I don't know exactly, like if you're going to X stocks, they were listed on NASDAQ exchange, and that's the single exchange. That's the only reliable price you can check is NASDAQ exchange. For other stocks, they might be on New York exchange or in other countries, but in most cases, it's just a single exchange with no possible arbitrage opportunity because it's like single pair, single currency, single exchange. And crypto market is sufficiently different. Landscape is very different. We have batch of exchanges, batch of pairs, and that's why I think it's fragmented among different exchanges, and it makes it more complicated. Landscape.
Yeah, I think I want to spend a little bit of time on traditional markets because I think in the blockchain / crypto space, we tend to think traditional markets are the superior thing. I think that's where I slightly have a different view here. I think as a general point, I think Dimitri, what you mentioned is true, right? You have NYSE or NASDAQ, right? You'll have a bunch of stocks that only trade in one venue, and then you don't have much arbitrage, meaning the price can obviously whatever the price is, right? That becomes the true price. However, and this is where however comes in, I think that's the key part here. um, I actually have done a session early on this topic, actually first month of XXIM or something like that when we got started. You'll be surprised that 90% of the trades, 90% of the traditional markets trades actually do not go to lit markets. So lit markets are basically NYSE or NASDAQ, right? They do not go to lit markets. They go to dark pools, what you call ATSs, which is alternate trading venues. And every company, JP Morgan, Goldman Sachs, they will have their own. Again, we don't want to spend too much time on this, but I think I'm just putting context. So I'm adding some context here. One of our guests actually spoke to Gary Gensler, who was the previous chair, and he himself actually have said that 90% of trades actually not go to lit markets. They go to ATSs, which is the dark pools, where you have block trades. So you do not have this order book style trading where you have, buy order sitting there, sell order sitting there. You do not have that. You have block trades where you have a buyer and seller decided the price themselves, and they're just trading it through the venue, and the venue could be by any of the prime brokers, right, or whoever. Bloomberg might have that. So I think the point perhaps I'm bringing that up now is traditional markets are great. They do function well, but they have a very, very different system like sort of ATSs. But they also have things like depository, right? You have DTCC that backs up everything. So there is a central custodian basically sitting there and taking care of that whole process of buying and selling. There is no actual assets that are trading, right? So just wanted to add that in the mix here, that those markets have a very different, because the exchange is not happening between the parties. The buy sell is not actually happening. You have depository like a banking system, so they take care of the settlement side. They have settlement sides, and they have rules like SEC used to have T plus 3, and they made it T+1, which is the settlement cycles. You don't have. So anyways, very different. But yes, coming back to the price, sorry, Eliott, yeah, you can jump in anytime.
Yeah, I mean, very interesting stuff. I didn't know that. I'm actually gonna look
Please.
a bit into that. But just Dmitry, for context, the 20% arbitrage trades weren't even on Korean exchanges. It was just between, I think, Mexi and Coinex, which are two like pretty used and classical exchanges. So I think it's still pretty interesting. Like in traditional finance, you can have like 2-hop arbitrages between forex trading if you use 2 currencies or more. And yeah, I just think in that regard it's less efficient. Like just it's crazy the price differences there were during the crash. Even though volatility is high, there should be a lot of money to be made, but if central exchanges can block withdrawals and trading, then these aren't even real prices because you can't act upon them.
Yeah.
So I think that's kind of the way I'm seeing it. If you want to define a global price, as you said, if there's only one exchange, it's pretty easy. Either you take the last traded price or you take the midpoint of the BBO. But when you have a lot of venues, then it is more complicated, and you need to do it fast. If you want a good oracle, you need to do it fast, and you need to be precise, which is why also I don't like the median, because it's nothing precise. It's just robust.
Yeah. So I guess so what are the challenges, I guess, within the crypto world? Let's just focus on that, right? Like, so if we were like, I guess let's define this, right? What's the challenge with coin market cap? If we were to take a price of on coin from coin market cap, which is sort of the average between different exchanges, right? Or I actually do not know how they come up with the price.
Yeah, I mean, that's the perfect example. Dmitry talked about it also in the last podcast, because CoinMarketCap is centralized. It's just one entity that's determining the price, and the aggregation algorithm is we're blind in that regard. We don't know how they aggregate it, and he could just manually set the price of Bitcoin to $1, and then every oracle that uses it would be screwed if they don't incorporate other aggregators.
Yeah, this even happened in the past. I think last year there was an event where ton price, by some reason on CoinMarketCap, drops to several times different from the exchange's prices. I think there were no even explanation what happens, but this even happened in the past. Yeah.
I mean, it even happened on Friday. I saw that the price of KASPA was at much lower on CoinMarketCap than it was on Mexi, for example. I mean, those were the two first things I opened, and the price was on CoinMarketCap was like 2 cents, and on Mexi was 5, or yeah, it was about 5 cents, and I was like, how is this difference possible? It doesn't make any sense.
Yeah. So we are talking about the latency here right now. I mean, I think I'm just ignoring the part that parties could jump in and try to manipulate the price of an asset, but let's give them benefit of doubt here that they weren't. That could just mean that it was.
Okay.
I mean, not that we are, but I'm just saying if you do in that instance, right, like Friday, where you had liquidations and different exchanges were trying to, sort of manage themselves. Um, it even that moment, it's like, how do you truly, if I'm looking at the price as a retail, I wouldn't know what is the true price, even if I'm going to CoinMarketCap and it's showing me all the exchanges. One is saying 2 cents, one is saying 5 cents, right? It's a massive difference.
But
Yeah.
both can be true at the same time, if I
Yes.
can pitch in.
So, of course, sorry.
Yeah.
Yes, please. Yeah.
No, because and this is also like what I was writing with the dams and the locks, like where the water flows to. If there are constraints, then sometimes the arbitrage won't take place. And of course, with TradFi, there's a lot bigger and more sophisticated infrastructure on the back end with all the actors that are doing trades in milliseconds, really. And if you are talking about latency trading, I mean, you can even hire, how do you say it, a server next to an exchange. So you have below 100 milliseconds guaranteed connection. So you can have a good trading. I'm not aware of those services being available in crypto. But for instance, one time when KASPA was on a new Dutch exchange, and the KASPA there, it sold out very fast, so there was a big price difference. For me, because I didn't have access to that, for me the price stays the same. But one of the guys in the Telegram group, he had his own arbitrage bots, and he had an account already in place on different exchanges. And he was buying, for instance, on Mexi, and he was selling for several cents more on the Dutch exchange. So for him, he had the cheap price, for instance, on Mexi, and I think it was Bitfavo, where he could be selling for a higher price. And for people who only had access to Bitfavo, that was their price. So those are, and what is then the true price? Yeah, you can say it's the average of the total market everywhere. But I think there will always be, depending on the location, a price for a person. And depending on the access somebody has to the market, he or she will have a different pricing. That's just one of the aspects, but I just want to keep the complicated aspects in the story, because I don't think it will be ever possible to find one specific price.
So Seb, actually very good. Thank you for jumping in, and the guys again, Jack and everyone who are listening to this as well. Please come up. Please do share. If you have anything to add, anything to contribute, please do tell us, and of course, feel free to jump up. But I think Seb, I was going to say though. It's great what you said, and I think arbitragers and arbitraging, I think we all like. It's great. It repegs the price back to the asset. Whatever the price needs to be, or to be a global price, right? Based on. But I think the challenge for me, I mean, that's great, but challenge for me, and I think it's more of an Oracle challenge, right? What happens if the lending protocols then average it out, and then 2 cents and 5 cents, to take that example, right? And you're averaging it out, which I think Eliott was mentioning, and then this is closer to the liquidation thresholds for the lending pools, right? Is it the true price? And I think perhaps that's where I want to go a little bit and spend time on that direction. Like, okay, it makes sense, but how? Like the oracles, Dmitry is running one of the oracles. what is the right way to then decide what is the true global price? Because two exchanges arbitraging, it's okay, it's between one venue to another venue. That makes sense. But now we are talking something bigger, right? We're talking hundreds of billions of dollars of assets that are locked up and waiting for someone to tell them what the price is. That's a different level of challenge. We're not saying that it's wrong between two venues, but I'm saying now for that system, the DeFi system to work, we need to define the rules of the game. I think that's what Dmitry said. Do you want to jump in, Dmitry, here?
Yeah, I can. Actually, I already told it on a podcast. Well, for ourselves, we decide that we focus on a little bit different problem. Yeah, we focused on a problem on bridging the data from the original data source on chain with the proofs that we haven't manipulated in between. That's one more way how we can hack the system. Even if we rely on like exchange and exchange shows the correct price, how do we know it from the smart contracts? Yeah, maybe we are okay with the coin market cap price and don't we think that it's fine, or our assets is traded on a single exchange only, and that's fine again. Yeah, so we can bring data from it, but Oracle itself can manipulate the data in between. Imagine that KASPA is only traded on MEXC, and so when we bring it from MEXC on chain, we divide it by factor of 10. Yeah, we can do it as Oracle. Well, we cannot do it as Oracle. Quex and other oracles technically can do it, to rely on different mechanisms, how they find the consensus of the price and so on. So yeah, I think I was talking. Yeah, so we focused on this problem actually. But I absolutely agree that another one exists: how to aggregate it, how to find the correct price. I think I see raised hands, so let's.
Yeah, Jack, please go for it.
Yeah, thanks. I was just gonna comment on what you guys were saying, because I think dealing with the consequences of not being embedded in a fair price is much more important in the subject that we are discussing today, and sometimes it's quite underestimated, in my opinion. And like Eliott said, I think that if we don't have a way to measure the right price of an asset, and then no matter how good we are at, fetching the data source and making sure that we are not manipulating it, uh, at the end of the day, we cannot guarantee that the price that we are fetching our data source from is the right one. So we cannot guarantee that people that are, playing with their money on lending markets are not going to be liquidated because the data source is not adjusted correctly. So I mean, the main point I think that Eliott is trying to solve is how can we attest that the price that we are providing is coming from the right source and is actually legit. And this is a fascinating topic, and I'm just following Eliott's work on that, and it's very exciting for me.
Yeah, no, thank you. And I think obviously what you guys are building at Cascad, you have the real implications, right? It's not just someone discussing the topic. You need to make sure, the real users that will come on the platform, you will have to deal with the consequences of whatever happens.
Exactly.
So you're on that sort of the extreme end of the situation where you need to find a solution one way or another, or you'll end up just implementing what's been done, which is pretty much the median, right, of all the values, and off you go, right? Whatever happens, happens. The user will have to just bear with it. So I do understand your situation, but I think as I said when we started the space, I really liked the analogy of Seb, who said the single price theory, because I think Eliott, you have a single price theory. Perhaps it's more of a assumption, or it's more of a idealistic view that we could have a single order book exchange and we can pull the price from that. And I think Seb mentioned that it's this price is like a water, which I really liked. But yeah, please jump in. Yeah, Eliott.
Yeah. Regarding what Seb said, I kind of agree. I mean, I see where he's coming from, but at the same time, for me, the point of this Dutch exchange, the whole reason that the price was so different is because of problems like opening the exchange and selling the asset if you don't have enough. And for me, this is more of a regulation problem. If they were doing things well, then there should have been no price difference between, because like your friend, you're going to perform the arbitrage. So to me, these huge price differences, unless you're talking about like Korean exchanges, which are a whole different breed, they shouldn't exist, because as soon as they exist, that means there's money to be made. And if there's not enough competition to fill this money and to take it, then for me, that's the meaning of an inefficient market. In theory, arbitrage doesn't even exist. So this is, of course, ridiculous, because information travels at certain speeds. So there's always going to be arbitrage with like high frequency traders who snipe market makers' stale quotes. But if you put that aside, then I think high arbitrage is an indication of not like an inefficient market.
Yeah, but if I may ask a question, for an oracle, if we make it very practical, like the Dutch exchange as an example, who ran out of KASPA, just to put it bluntly. I'm not exactly sure what happened, but that's what I heard from the others. But also, if we are looking at now, let's say the flash crash from Binance recently, but also like some times ago, it was with Mango. Yes. So those three are the outliers, and those three are all different prices. And my presumption is you can never get the price, but there will always be blobs of different prices due to, for instance, also information differences. But I do agree, they tend to hover around a central price point, because the moment that doesn't happen anymore, there's money to be made, and yes, there will be arbitrage, etc. But I think for oracles, I think it's most important in this concept to be resilient against these three outliers and more, because these outliers, they can have a cascading effect if you go along with an outlier that is happening.
I completely agree. And what you said with for example, say the Dutch exchange gets drained, then in my view, an efficient market should have huge firms who are seeing this arbitrage, because if there's very low liquidity, then people are willing to buy KASPA for much more expensive on that exchange, and they should all be dumping their KASPA there. I mean, I would personally be buying tons on Mexi and selling it there, but if it's only like small traders like myself, then this won't fill the gap. The arbitrage will stay for a long, long time until there's enough people who are performing it. So, and same for liquidations. The cascading event is because one exchange depegs, which is very common. This is just market manipulation. And then after that, there's a liquidation cascade, because a lot of people were only trusting Binance's price, which is not the way to go. And you need to filter out that outlier. So this is a good example, and this kind of nourished my thought in the past 2 weeks. If I create an oracle, which the one I'm looking at is aggregating limit order books from everywhere. How do you when you want to flag an oracle as an outlier? How do you differentiate between just market manipulation, which shouldn't be flagged, because the goal of an oracle is not to detect market manipulation, it's to give the price of the market. So manipulation is a whole other subject. So how do you flag something that is a genuine problem from the exchange, for example, blocking withdrawals, blocking trades, or just market manipulation. And the way I've tried to think about it, and the conclusion I have right now, is I think the most logical one. Imagine you have this global order book where a lot of exchanges are like, it's a calm market, so everything is around the same price. And one exchange like Binance depegs. Now there's a huge arbitrage opportunity with Binance. The question is, how fast does that arbitrage fill? If it doesn't fill fast enough, so then you need to define what fast enough means. But if it doesn't fill fast enough, then you have an indication which, in an efficient market, the only reason this arbitrage could stay in time is if there's a problem at the venue. They have blocked trading, blocked withdrawals, blocked deposits, but you cannot perform that arbitrage because it's free money. So if it doesn't get filled up fast enough, then for me, this is an outlier.
I think that's exactly. Sorry, Seb, 1 second. I think that's exactly what happened on 10th also, right? At least that was reported. What happened on the Binance side, that their APIs went down, and no one could access. Even market makers couldn't access that venue for some time. So that's what the example you're giving, right? If the arbitrageurs can't access the exchange they wanted to access for whatever reason, it obviously leaves the hole, right? And in fact, it makes it worse, which I think could have happened at Binance. We don't know, obviously, but that could have led to this cascade of events that happened.
Yeah, but I'm not sure. Does anybody of you know how the market makers reacted? Because we are also talking about flow toxicity here.
Yes.
That they have detection in place, I presume, also here in crypto. They must have to protect themselves, and that can also mean that they are withdrawing their activities, which only enlarges the issue at that certain exchange.
That is a very, very, very good point, Seb, and I thank you for bringing that up, because I think I wanted to take that discussion on that direction. Basically, that what happens. I mean, it's great when we're talking about arbitrageurs. So it's great when we're talking about, excuse me, that there's an opportunity, market makers or arbitrageurs can run to get that trade. But what happens if you take the completely opposite side, and we've seen it, which we call liquidity events, where everyone pulls back. In fact, that's one of the big things people are looking at on the 10th. For half an hour, there was no market maker activity. So they were not present for that half an hour. So there are plenty of data, actually. People have looked at the data. And this has also happened in 2020. This has also happened in 2019. This has also happened in 2008, where when you do have liquidity crunch, the big players especially, pull back. And that's the opposite side of what Eliott you were saying, essentially. When their times are good, everything is good. But what happens when there is no, big players present? The order book is very thin, basically, right? The order book is running thin on one of the biggest exchanges. In that case, it almost creates the opposite side of the scenario that you're considering, right?
I mean, the way I see it, honestly, is, for me, it's almost the same thing. So what happens is, if you have a lot of people who take out liquidity, then obviously it's going to be way more volatile and there's going to be arbitrage everywhere.
Well,
so now,
no, sorry, Eliott, but how do you think?
why not?
Why do you think there'll be opportunity? For opportunity to happen, you have to have someone buying and selling, right? So that's exactly what the job of a market maker is. And I think, Dmitry, given you have played in that space yourself, you can jump in, right? They're providing a bid and ask on both sides. They're not just playing in one side. It's not the retail that comes in that just sucks up all the liquidity if someone tries to sell, right? No. They're actually doing the both sides of the equation.
Market makers, they provide liquidity, and arbitrage is taking liquidity.
Which is, let's define them, right? And it's good because when you're saying provide liquidity, they're providing bid and ask here, right? So both sides of the trade.
Yeah. So limit orders.
Yes.
Limit orders.
Limit order, but both sides of the trade, right? They're not just providing one side of the trade. Yeah. Cool.
All right. Of course.
Yeah.
Market makers, they have limit orders, and the whole point of an HFT arbitrage bot is to take from limit orders. It's to use market orders.
Yes. So the scenario, I guess. Sorry, Dmitry, if you wanted to jump in.
Yeah, I can jump a little bit while I was still here. So actually, market makers are a very good source of price. In most cases, market makers
Yeah.
provide their own prices, and you can use them as a data source. That's also possible. And yeah, the fun stuff here, we talked a little bit, the Eliott talked about like efficient markets. I like this no trade theorem, or I think it's also called Milgram-Storky theorem, which tells that like if all the market is absolutely efficient and every player have all the information, there will not be any trades ever. Yeah, if we all have all the information provided, then there is no reason to buy and sell. We'll just change position of our buy and sell orders, but they will never match because we all know the information. So trades, that's my way to how I look to the markets. I like this way. So all the trades only happens because of some asymmetry of information, of opportunities, of speeds. I think Seb already told about this collocation stuff. We move close to exchanges to have low latencies. So all of this trades happens actually due to inefficiency of the markets. So we'll never have absolutely efficient market when we'll have an absolutely reliable price. Or maybe we'll have at some point then the market will be dead because there will not be any trades. So we only have trades because of inefficiencies of the markets, and that's why this problem actually exists. It's some kind of fundamental problem. Until we have trades, until we have trading volumes, different people consider correct prices as different ways. We talked about this Dutch exchange recently. I actually think that it's an honest price. If like it was drained from the exchange and like there were no enough cars on that, it doesn't mean that the price is incorrect. Someone was buying at this high price, yeah, or someone was selling at this low price. That's not. They were ready to buy at this high price, even maybe knowing that it's higher than on other exchanges. So it should also be considered, in my opinion. Yeah, but the market is inefficient. We can remove this kind of reduce this kind of inefficiency, but it's still inefficient.
But sure, I agree. But imagine I'm willing to buy KASPA for $100, then that shouldn't mean that the price is $100, right? If there's a small set of people who are willing to pay much more in a drained exchange, and weirdly there's not like the arbitrage isn't being filled, then there's probably something wrong, no?
Well, something is wrong. It can be better. But yeah, you told it correctly. If we are going to less liquid markets, the price is something. The price is if we have something ready, someone who's ready to buy at this price, then it's an honest price right now. It might be different in different regions, especially if you are talking about like not public companies, we're talking startups. What is the price of this or another startup? We see different valuations of not launched project, yeah, pre-IPO or pre-launch tokens and secondary markets. So the price might be very different. It might be different in different regions. It might vary on check size, on your residence country, your passport, whatever you want.
Yeah, Dimitri, I love actually that analogy because, and I think that's sort of how fundamentally how I think about the price. Of course, there's a practical side and there's a sort of idealistic side of the things, right? And I think that's the true nature of capitalist society, right? Like startups in crypto, but also startups in general, right? Like it's not like the value is decided by the revenue or PE, which is the price to earning ratios. None of that, right? Like early on, startups are priced based on what a founder says my valuation of the company is, right? And if someone is willing to pay that price, that becomes the price of the company, right? And then you go through Series A, Series B, blah blah blah, right? You get to then public markets. Even there, like you have sort of banking institutions that come in, private equity will come in, who will try to value up your asset and say this is the price, we'll go to the public markets, right? So it's not like the price is decided by anyone, it's just one or bunch of individuals that decide the price. A very interesting analogy nevertheless.
Actually,
but
even for sorry, sir, I add one more thing. Even for tokens, if we're considering price as something that fundamentally exists, we should also consider like locked tokens, vesting, and so on. And I know a lot of people who are telling that the honest price of this token should be much lower because a lot of tokens are actually locked right now and they're not available on the market. When they will be available on the market, the price will go down. But actually, right now, the price is like that because there are people who are ready to buy at this price.
Yeah, exactly. It's just even in the illiquid markets, things work. But I think sorry, sorry guys. You want to add anything, you can add. But I was going to again set the scene for everyone who's just joined us now, guys. Thank you for joining us. We are discussing this topic of how to find the price of an asset, right? In case we're discussing Kaspa. Price, like how do you define the price of an asset? So that's the topic for today, and again, as always, please jump in if you have anything to add. Feel free to add, feel free to jump in, and Christina will add to you, but please, yeah, Eliott.
it,
Let
yeah,
Seb speak.
if I may add to what Dmitry was just saying, I also think that on the Dutch exchange, it was an honest price because people wanted to pay the higher price because they just want to buy Kaspa, and they didn't have access, or they didn't have an account on another exchange, so they were willing. I mean, they also have CoinMarketCap, but they were willing to pay a premium just to own Kaspa, and that's also, I think, also for Eliott, this is one of the most difficult things he's facing, because in this case it was an honest market mechanism that drove up the price. But if we, for instance, look at Mango a while back, a few years back, it was also a thin market, but it was, well, let's say by a bad actor, the price went up. And how to differentiate between that will be, yeah, that I think that is one of the most difficult things to do, especially, well, I think, yeah, the market makers.
But do you agree it can be
Yeah, sorry.
honest, and do you agree it can be honest and inefficient at the same time?
Yes, yes. Oh, that was in the Dutch market, 100% sure. Yes. Yes,
Yeah. So
that's
the
why,
way I
because
see
it was
it is,
inefficient, that's why the price rose.
yeah, exactly. So I agree that I'm kind of in a more idealistic scenario right now, looking at it from a how a market should be, and that right now it's not effective. But
Yeah,
I, I even if the price is driven up a bit, I would tend to flag that exchange as an outlier because it is an outlier, and even if it's honest and it's not price manipulation, um, I mean, the way I would see it, right, is imagine you have this Dutch exchange, and that often has um some arbitrage opportunities for the reason that maybe others don't have accounts on Mexi, etc. So in that case, let's say the average $5 arbitrage is filled in 1 minute or more, or like say even 1 day, depending on how ridiculous it can be, then I would detect it as an anomaly if it is much larger than it usually is with the rest. So say you have this global limit order book, and now your Dutch exchange is off by $5, then usually it'll close up in 30 minutes. This is not good, but that's how this exchange is. Now, if there's a big arbitrage and it's been going on for 1 day, when usually it closes up in 5 minutes, then I'll flag it as an outlier because I'll be saying, okay, this is unusual behavior. There is no way that the people who usually close it up in 5 minutes don't close it up in a day. You see, like,
Yeah.
so I won't just flag it because there's an arbitrage. I'll flag it if it's anomaly with respect to how it usually behaves.
Yes, I think it's good. Only I think the time frame should be a lot shorter instead of looking at a day.
Oh yeah, this was just an example.
Okay, because
it's more milliseconds.
because I mean,
Don't worry.
these things happen in matter of minutes or within the hour at least, often faster. So it's really
yeah.
time is of the essence.
We're focused on making the Oracle optimized so that we gather data very fast, aggregate it very fast. I think right now our test aggregator aggregates like all limit order books in like 50 milliseconds. So it's
That's
good.
very nice. And but then another thing, because of course we have the flash crashes, but we also have now let's say the melt ups. But what if somewhere in the world something bad happens, and like say the Strait of Hormuz gets closed, and people want to mitigate the risk and sell assets to go into cash? Then you will also see in a few minutes a crash, but that's an honest crash, and maybe because it's happening somewhere in one exchange. Now, well, the Strait of Hormuz, everybody will know it, but say it happens in another city or in another country, and people from that country, they know, and the rest has a 5-minute delay in the news, for instance. How will you deal with that?
I mean, don't you think that, okay, so example, one country everyone wants to sell, which is a very good scenario. The way I see it is, in a somewhat efficient market, then your price should go down not on a single venue. It should go down globally. So if your price is going cheaper and cheaper on that venue, then what I'm going to do as a normal like arbitrager is buy every single sell order on that venue and sell it back on exchanges that have not had this information or are sitting well. And so basically, instead of just having this price crash and other prices stay normal, by doing the arbitrage, I'm going to spread the price drop across all exchanges.
Okay, and in such an event, I suppose that the market makers will be one of the first to be informed, because that's in their system, and they then withdraw their liquidity.
I mean, even
I'm
if there's
I'm
less
looking
liquidity,
I'm really looking for the outliers here. I know, so
yeah. Don't worry. This is like the good thought I need to.
Guys, this is a friendly space, so these are good questions.
Yeah. I need these questions to see if there's problems.
I'm waiting, Eliott. I have plenty. But I'm letting Seb ask all the questions. And Dmitry, please feel free to join as well. Jump in anytime.
Yeah, I wanted with a pretty simple actually idea, maybe some kind of answering to questions of these situations where one country or one exchange we have a big diversion. There is pretty common way how we measure this. It's called like trimmed mean, where we remove prices like when we drop like biggest or high and the highest price, for example, biggest and the smallest price, or like prices that deviate from the mean more than 10%, for example, and we don't count them at all. This might be a solution in a lot of cases. So if you consider this kind of pretty liquid assets, so we just drop all the exchanges, we do not use them and aggregate if they deviate from the mean value more than 10%. So in some country, price might be very different, but we just don't count it so far. Later on, arbitrageurs, market makers will go there, will reduce this inefficiency and the price move globally to some more more reliable value. But right now, we just don't count this these values that deviate too much from the mean value.
So interesting. So Dmitry, you're saying just if they are deviating from the average value or some sort of value, do not even count them. So outliers do not be shouldn't be considered.
Yes, well, at least it's a possible solution.
I see.
Pretty common one, yeah.
Yeah, yeah. Is that how Chainlink does it? Do they? I thought they have something similar, right? They remove the outliers from the leader-based consensus before they send the price to the blockchain, to the smart contracts.
I mean, for them, it's a bit weirder because I think they tell each one of their nodes to already compute the median. So it's a median of medians.
Yeah, but I think they do have like some sort of exclusion on the outliers. So they do not only median, but they do on purpose exclude the outliers, and then they do median of median. So something like that.
Oh yeah, maybe they exclude, like, they take the median of the 75% limit, or I mean, no, because if you exclude the same amount of outliers on both sides, then you're back to the median either way.
Right. But maybe that's why they do it.
But
maybe
they penalize.
Yeah.
Maybe they slash.
Yeah.
Somehow, but
yeah.
But yeah, the median is, like, in statistics, you use the median when you want to be robust but not accurate. So that's why I kind of don't like it. I think it's just too like, it's too easy, you know? It's like this magic solution.
Come on, Eliott.
Gives
Spill
you
the
price.
beans here. Why you don't like median? You are so vocal about median. You need to tell us.
I mean, like, every Oracle white paper I've read is saying, sure, we take the median with a little tweak, like we weigh some people or we take away some outliers. And then basically it's if a half of the nodes are honest, then our game is safe. And I disagree for two reasons. The first is saying half of the nodes are honest is not the same as in a consensus like Bitcoin, where the rules are deterministic. It's more subtle. And the second reason is, even if your final price is between two honest nodes, that doesn't mean I cannot move it inside those two honest nodes. So basically, I, as a player, will always, if you look at the Nash equilibrium, there's always an incentive to report a price slightly over what you've seen and deviate the Oracle price. Now, of course, this is kind of negligible, and there's so much arbitrage anyways that if you skew a tiny bit, you're not really creating an opportunity. But if we place ourselves in a theoretical framework where there exists a true price and you can trade upon that true price, then I will always have an incentive to lie by a little bit.
Yeah.
And what I really don't like about Oracle papers is so many bold claims with absolutely no mathematical proofs behind it. Like, come on, guys. Like, some of these guys are PhDs and there's no proofs. I'm like, what have you learned?
Yeah. You are very, very vocal about it. And I think it's great because we need more people like yourself to really, I guess, question the system as it's built, because it's still very early days of how it's being built while we speak. But Dmitry, anything want to add? Otherwise, I'm going to just carry on with my set of questions, which aligns with Seb's thinking.
I think I'm done at this time. We're already speaking here for 1 hour. Thanks.
Oh, I see. Sorry. No, thank you. If you want to sit tight, you can sit tight. You can listen. But if you want to jump out, that's totally fine as well. You know,
I have to go just now. So.
Cool. Well, thank you so much for joining us, Dmitry. It was really good to have you and your perspective. I think you're gonna miss out on the rest of the discussion.
Thank you for coming, Dmitry.
Yeah, thanks a lot. Thanks, everyone.
Yes. See ya. I had a question also for Dmitry and for Eliott, to be honest, because I was wondering, what is the function of an oracle, because with all the skipping of the outliers and going for the mean of the mean of the mean of the mean, there is a lot of information being lost in the process. And so maybe instead of just ignoring the outliers, because it can also be that there are, I mean, yeah, what is your philosophical standpoint as a, that's every company has to think for that for themselves, of course, but how do you see your own place in the whole ecosystem? Do you see it as a place that will be telling or deciding on what is truth, or do you see yourself as a place that is spreading, gathering information and spreading it to the market? Because those outliers can also be important information, and if they are just left out of the equation, your customers are missing out on maybe a good opportunity.
Yes, I agree with that. And that's why the whole point of like what I'm trying to design is really not flagging too many people, but I still have to be robust in what happens when there's a big event like Binance. So it's a tough one. I see it as you said, I don't want to lose information. So that's why I'm simulate, like my idea is basic. It's at a given time T, you aggregate limit order books, simulate arbitrage, and there you go. You have your global limit order book. Now, the point is you get even more information, because by doing this simulation, you get what is the arbitrage opportunity at this time? What is the arbitrage opportunity with a certain exchange? So is that exchange exhibiting more arbitrage than usual? If it is, then if this arbitrage is staying for a long time, there might be a problem. Why is it not being filled? And so, yeah, the goal is to not lose information, like you said. Also not trust, and the decentralized aspect, of course, is important. That's why we're probably going to be using Quex, because you have to trust the data. And but yeah, it's tough, because right now the whole math I'm writing down is, am I sure that I'm not going to flag some people as outliers when they're not? And more importantly, am I going to forget to flag someone when they should be? Which is tough, but I think is doable.
Yeah. Hey, Kaspa KAI, good to see you. If you have anything to contribute, please come up. I think I saw you were raising hand, perhaps. Please come up. But yes, great chat, guys. Eliott, I do want to, I guess, go back to the scenario. I don't know how much time we have. I know you said you have an hour. So if you need to wrap up, we can wrap up. But I do have one scenario which I wanted to, I guess, perhaps just lay it out here. We don't need answers, and I think, of course, you're going to take your time, and you need to sit through and understand the situations. It's not an easy answer, and I think that's perhaps why we are here. And I'm more than happy to host many more spaces on this question alone, because I think it's the most fundamental question for me personally. I don't know why, because perhaps Tradify, as I said, is also in the same boat. But just going back to the scenario of, like, I think the scenarios we were defining were like, when the times are good, this Dutch exchange we mentioned, when the times are good, everything flows well. Like, that's what we call liquidity, right? And I think that's what Seb rightly so mentioned, water. And I think it's the word actually money uses, the old money uses. When the money moves, everything is happy. Everyone is happy, hunky dory, good day. Well, when money stops, I think that's the scenario perhaps is when things go bad in traditional finance and in crypto. And that scenario, I think, is the one I think Seb highlighted before, and I think that's the one perhaps I spend a little bit of time thinking about sometimes. Again, 10th of October was the same day. I think for me that happened because people pulled back on the liquidity. So I think we started quickly discussing that point before, which is what happens when actually there is no liquidity on buy and sell. right? People want to sell like retail or institution, but there is no one to buy the liquidity, right? And you have this massive spreads on the order book exchanges that starts to percolate throughout, right? These spreads grow because there is no one that is wanting to take the risk. Because end of the day, finance is all about risk taking, right? Someone has to come in. So typically, that's the market maker's job, right? They will come in to take on the risk, but if they think the risk is actually worse for them, and there is the down, like it's not that they can come out and buy this price at 2 cents. And if they think or they know something, which is informational asymmetry we talked about, that it might drop even further, they might not want to take the risk, right? So I think that's the scenario. Perhaps I don't know how much time you spend thinking about this. I think that's the scenario for me is unpredictable because the risk taking is very human nature.
Yeah, I think that's an interesting scenario, of course, because it happened also. But so the way I see it is kind of like in HFT you snipe stale quotes. So if say there's two exchanges, of course both with very low liquidity, and on these exchanges everyone is starting to sell, market makers are starting to remove their orders. It's basically chaos.
Yes. Yeah.
Imagine there's one that has reacted faster to the information. So, for example, let's take Mexi and Kraken.
Mm-hmm.
Mexi has crashed much lower, and Kraken is kind of lagging behind, but it's still crashing, but
Okay.
it's lagging.
Mm-hmm.
Then, if I'm fast enough, just like an HFT firm would be, I would buy orders on Mexi, so lower,
Yeah.
and snipe stale quotes on Kraken, which is market makers who are struggling, who are not fast enough to remove their order, front run them and buy when they don't actually want to sell, but they've actually not canceled fast enough. So I think even in this
Yeah.
very illiquid market, there will be more volatility, of course, but if you're like, if there is arbitrage, then it'll be filled. Now it's harder to fill because you can buy easily, but you can't sell
You
easily.
can't sell. But even there, you have to understand the I guess the latency that perhaps is not the right word. The algorithms that HFTs that you're mentioning, high frequency trading, even you need to understand how the market makers are structured. And weirdly, this all comes down to volumes then, right? Because okay, right, we're talking about numbers here, right? So like if Maxi is 1/5 of the size of Binance, right? Yes, you can run to Maxi, but you can't suck up all the liquidity, right? Or you can't sell all the liquidity from Binance to Maxi. So I think what perhaps another factor here is the size of the book that you have to get rid of, or you have to perhaps, or you're wanting to take on, right? Because that's where comes back to the liquidity or how much.
Sure, but
Yeah, but yes, you can get rid of some of your.
once there's no more arbitrage, don't you consider that even if the price is crashing, that is the price?
Well, yes,
Yeah,
yes,
well,
yes, yes, 100%, 100%, and that's perhaps what I'm saying. Like, yes, that is the price. That I think in that moment it becomes real, but that's where the spreads become very high. Like, the spreads start to grow, and I think when the spreads will grow, Oracle, the averages will get wider and wider between different oracles when the spread starts to grow between order
yeah,
book.
and I have a question because I'm not informed enough to know how the market makers in crypto are doing it. But it's really different from TradFi because, yeah, for instance, I'll take myself when the flash crash was there and Bitcoin didn't crash as much as KASPA did. I shot on a DEX a swap from Bitcoin to KASPA, and I thought, yes, I'm going to be extra rich in KASPA. but instead of getting 1.8 or 1.9 cents per KASPA, I got a 4 point something in the end. now I understand it, and when I was doing it, it also was a little bit risky. I knew, but and I didn't read it good enough. I thought I was locking in the price at that moment, if I'm honest, but I made a mistake. But okay, that happened. But how do market makers do it? Because if they are going through the blockchain from one exchange to another, or do they have just virtual books with the exchanges? I'm not sure, to be honest, how that works in crypto. Because if it's going on the blockchain, there is and I don't want to use the word latency in this because that's something different. But there is just a transaction time between it,
Yeah.
which increases the risks for them, which they don't like.
I think what you're talking about is very interesting. Oh, sorry, Christina, you have something to jump in here, please.
Oh, no. I just wanted to. There was a question from Ezra. So as soon as you guys finish this, this thought, I wanted to ask.
Jump in there. We can jump in first, yeah, with that question.
So what is the risk that the second path leading from the point of decision to the rest of the network is longer and less dense than that longest route going the other way, which also eventually encircles the entire network field of working computation, hopefully small and negligible.
Long question.
Sorry.
I'm not sure I understood.
Yeah, so perhaps, guys, if you go, it's a very long question. So, guys, if you can go into the comment section, please. Yeah, if someone can go into the comment section
Oh
and
boy,
read.
it's a very good question, I think. I don't know if I understand. Isra, please do come up if you do want to ask any of us that question, or Eliott. I don't think, at least I don't understand the question.
I think it has something to do with latency, but
Yeah.
also, Seb, by the way, like on centralized exchanges, you don't go through the blockchain. So the reason I think your order didn't pass is just because market makers can have on certain exchange priority over your orders, and they can also just disable trading and put their own orders first. Like it's first come first serve.
Yeah. So Seb, that's exactly it.
But manipulated.
So we have Isra. Isra, please jump in with your question.
Right. So it also shows this other thing. You can have a board of circuitry, and there's a theoretically longest operation you can run on a board of circuitry given a architecture. You design it, you have a structure of a logical command that you run on a machine.
Mm-hmm.
So it can be very simple, but this question is basically just that. So imagine it works. You've got the entire network. It has no problem, but there is a way where you can settle for less than the optimum, right? But it's so that nobody's like eventually going to send it to the wrong address or to to make it difficult so that your computer can use it, given you only have 500 or so megabytes. If you have less than 500 megabytes on your device, you can't compile anything yourself. You need to have like somebody else do it somewhere else, which also relies eventually on a lot of other things that you can't even keep on top of that. But just having a better machine really helps. So the question is, the entire network of the internet is just a bunch of these machines. Okay, they have different memory capacities.
Yep.
Right. We all know that. That's why Amazon crashed. Good. It's obvious. So
Yeah.
you want to have it so that where you don't miss out on the part of the transaction that allows for somebody to eventually say to more people sooner, well, you're very far away and still not even coming back our way yet again, what you're already going to pay for your price. But, if they could do that, and they keep it there, that's fine. But that's eventually in the same logically equivalent class of inferences that you would make from a situation where, once you got back, you just tell us what you want to pay for it, and then we, that's we know what you're saying.
Is right. I think it's interesting what you're saying. I'm still trying to process. Are you saying the price is basically what someone is willing to pay for it? Is that, like, if I'm summarizing your thought there, is that what you're trying to perhaps structure?
No, not really. I mean, because in my opinion,
Yeah.
it's worth what it is. It's no price, right?
Mm-hmm.
You use it to run a machine. It's KASPA.
Mm-hmm. I see.
I can think of things I could use it for.
Sorry, you mean the electricity cost? So if it's, you end up paying 4 kilowatt hour to run your machine, that's the price of KASPA. Is that sort of the inference you're making here? Is that how you're thinking?
No, well, I mean, not even really, because
Mhm.
there's solar technology, so it's in some senses free.
It's free,
It's
yeah.
entirely could be even being paid. This could be like, a side hobby.
Yeah, yeah. So,
I think if I understood correctly, you're talking about latency of information, given like some people across the world won't have the same information at the same time. For example, some people will react to Trump's news faster than others, and there's the limitation of the hardware and the propagation of information, which, yeah, in my opinion, is just like part of the game of a decentralized system, and will create arbitrage, of course. So, but even taking that into account, there's a way to determine somewhat of a fair price.
not sure if that's. I mean, again, is there a come up if you do want to, and if Eliott did answer?
You can hear me, right?
Oh yeah. Sorry, it says listener. So usually it says speaker, but I don't know why.
Well, there's tons of bugs. There's tons of bugs on X, on the platform.
That's
You
true.
know that.
That's true. Right, but does it
But the
answer your
idea I
question?
think is interesting too.
What Eliott?
You're using this. It's like a UTXO. You use it to buy things, but you could use it for other. It's very cheap, the idea, and it's also very safe. Like, this is something that you can use and not feel like you're walking around with something that somebody would mug you over, because it's essentially, you could make all kinds of technology for it to like be activatable only by, they'd have to kidnap you for them to get hold of it, basically. So I mean, that puts the constraints on a lot of stuff to a very maximal degree. They're very strenuous, but it also in a lot of other ways makes it very safe, so that you're not walking around constantly with stuff. I don't know, stuff that would get you killed. No. So, anyways, you could use this to do a lot of. Well, I mean, they're going to use it for energy, which is the best part of it, which makes sense. You can use this to allow a machine to operate. I think is an idea that's kind of what I'm saying.
I like what you're saying, Israel, but I think you're too abstract. I think it's great.
Okay, well,
Yeah,
there's an idea. Do you know about like topology? Okay,
Sure.
so do you know about like an epsilon neighborhood around
Sure.
a point
Yeah.
in space? All right, so Whitehead's ideas about geometry is you replace all topological points in Euclidean space with the neighborhood of points around the point into a kind of dispersal of cloud of of some kind of distribution of a function of some sort, right? A network is a kind of distribution of a function of some sort, right? These things, they're in some places you have virtual machines, and so you have to make sure that all the memory. How do you explain that? So that it works, so that it doesn't crash. I guess sometimes it crashes. I mean, I can't build any of these things personally because I only have 500 megabytes on my dumb little laptop here. It's really a tablet with a fancy keyboard.
Please, Eliott, yeah, jump in.
Yeah, sorry, I'll just need to go soon.
Yeah, perfect.
Yeah, go quickly. But the point about the topology of the network is important, because this means that all the functionality that I can use on Kaspa for like, there are other platforms where you can make use of like 3D, not 3D, but Web3, infrastructure. You can use it to run your apps on. You can use it to allow people to use machines. In some sense, there's going to be this problem where somebody's going to be afraid that they're going to get like signed out of the internet because, but that'll never happen, but
Yeah.
ooh, it could.
Yeah, I think Israel. I think it's great. These points are great, but I think it's slightly perhaps more, off topic for today because really what we've been focused. I don't know when you joined us, but what we've been, I guess, chatting with.
He's discussing how he's going to keep people from arbitraging the hell out of Kaspa once it gets listed, right?
No.
On large exchanges. Don't pretend like that's not it. How dare you lie to me now?
That's not what we're discussing. I think not what we said. In fact, I think this is my take. I guess Eliott, you can jump in here as well. Um, in fact, what we're saying is in a healthy market, arbitragers are there to sort of repeg the price on different exchanges. So it's sort of a healthy way of how things work. So arbitragers, in fact, are doing God's work here by fixing the price of an asset from one exchange to a global price, right? If the price was 5 cents of Kaspa somewhere, and it would drop to 3 cents or 3.50.
Yeah, you're bringing us back to energy and cost and all this, and running machines and figuring out how cheaply you can get it done, etc. I understand that.
Well,
No?
there's actually more to it.
I'm gonna need to go, guys.
I would jump in. I would say there's more to it. I don't think arbitrage.
Hey, Ankit, sorry to interrupt. We need Eliott. We need to let Eliott go.
Sorry, Eliott, you need to.
Yeah, see you.
Thank you
guys.
so much.
Thank you so
Eliott.
much.
Thank you so much, Eliott.
Thanks. Bye.
Yeah. Guys, I think we're gonna wrap up this space as well. Sorry, Israel, what were we saying? Let you finish first, and then we can wrap.
God bless. Au revoir. À tous.
That's amazing. All right, guys. Seb, any closing thoughts? I think Eliott had to run, but let's just wrap this up. It was a great space. I think we went over so many different areas, but yeah, I let you just sort of, I guess, wrap up, and then we'll close the space.
Well, I think to wrap it up, we can end with that. It was indeed, as predicted, a very easy question.
Yeah.
But sorry. It was a simple question, but it's not an easy question. How to decide what is the price? So, and yeah.
Yeah, it wasn't. But thank you so much, Seb. It was great, and thank you again for everyone for joining us. I think we'll be doing more of these spaces. So appreciate everyone coming today here to listen to us.
Yeah, thank you so much,
you.
guys. Thanks for joining, and have a good day, morning, evening, whatever. Thank you, Ankit.
Take care, guys. Bye bye.
Bye.